1400 hours this Monday afternoon. A very good afternoon to you. Thank you so much for joining us here on Market View as we start a brand new week. We hope that you are in good spirits. Coming up on the show today, a continent at the crossroads. The sub-Saharan Africa is navigating a wave of economic headwinds, weaker global demand, high inflation, a fragile fiscal space, but beneath the turbulence, there are glimmers of resilience, and in some places, opportunity. The World Bank's latest Africa Pulse report offers a sobering read, but not without strategy. Cesar Calderon joins us on the show today straight from Washington. He is the economist for Africa at the bank. He helps us walk through the numbers, some of the challenges and the assumptions that are there, but he also spotlights what the future holds, especially for our kingdom, the kingdom of Eswatini. We want to try and hear his smart analysis as well as his honest answers, a conversation that matters. All ahead here on Market View. Of course, per usual, we will start the show with our business news, and then later we have Sandy Lesbia joining us for his market analysis. Let's start the show. Our first story, in a statement, the governor of the Central Bank of Eswatini, Dr. Philip Mnisi, said that the impact of the U.S. tariffs will negatively affect the South African economy, Eswatini's largest trading partner, which could lead to the South African Reserve Bank raising its repo rate to curb resultant inflationary pressures. Dr. Mnisi stated that as the South African Reserve Bank raises the repo rate, the Central Bank of Eswatini is likely to increase its discount rate to directly address the inflationary pressures as well as to maintain alignment with South Africa's repo rate. Now, what does this mean for local businesses as well as our consumers? We spoke to the Chief Executive Officer of Business Eswatini, Inathi Dlamini, who said that this development will not bode well for businesses.
Each time the central bank raises interest rates, the banks always respond in kind. If they raise it by 0.5%, your prime rate also goes up by 0.5%, which means if you owe the bank, you're going to end up paying more. But if we are saving with the bank, you end up making more money. So there are always winners and losers. But the central bank always increases the rate, and that's what the governor was saying. To say, if the Reserve Bank in South Africa raises their rate, the country may have to. And by the way, for the past 2 years, the country has not necessarily been following South Africa. That's why today we have a variance of 50 basis points between the two countries. I think their bank rate in South Africa is 7.5, ours is 7. And it's been different by maybe 0.5% in between. So not necessarily that when South Africa moves, the country moves. Not necessarily so. That I can assure you, for the past years, it hasn't happened that way. But they're not too far apart because they're part of the same monetary area, see, a common monetary area. And in reviewing interest rates, they must look at ensuring that we protect the peg. We also protect or rather mitigate the scourge of inflation in the economy, which is central bank, and looking at the purchasing power of the money that we have.
Chairperson of the Eswatini Consumers Association, Bongani Mdluli, urges consumers to take interest in following the latest developments in the economic landscape. He urges consumers to spend wisely as he foresees that goods will increase, hence the need to exercise caution in spending.
Kubathengi ukuthi bayithathe i-interest ngekulandzelela letindzaba letendeka kwemhlabeni, and futhi siyacela kubathengi ukuthi vele nawubuka lesimo lesitako nangabe kwenteka kukhula tintfo ngale directly or indirectly kukhona lokwendekako lapha kithi utawukhanza ukuthi tintfo setiyakhula etitolo nakuphi nakuphi. Sesingacela nje kubathengi ukuthi cela ukuthi babe responsible in their spending banake sekude lesikhathi sekuthi utawuspenda nje imali utijabulise without i-consideration yokuthi le nto leyo kukhona yini lekulethela kona wena. So siyacela kubathengi ukuthi kube nendlela yokuthi timali labatsebenta matima kube timali lebatawati ukuthi titawusebenta tisebente futhi ngendlela lengiyo.
The central bank says since changing the interest rate causes a trade-off between inflation and economic growth, the increase in the discount rate to reduce inflationary pressures would further suppress economic growth. The governor continues to say the withdrawal of foreign aid, especially PEPFAR, which was contributing a yearly estimated 1.243 billion emalangeni to the Ministry of Health, will have an impact in reduced aid inflows. Reduced aid inflows will reduce domestic tax revenues, particularly pay-as-you-earn, as well as value-added tax. For Market View, Nelson Dlangamandla, Vuminkosi Nzinisa Mbabane.
All right, let's go for a net break. We'll be back shortly with our Enterprise Watch segment.
Eswatini TV has signed a code of conduct that is enforced by the Eswatini Communications Commission. We are committed to reporting news that is accurate, comment that is fair, and programming that does not amount to hate speech or the description of gratuitous violence or explicit sex. For any complaints of our programming, please contact us on 2411-9600 or email info@eswatinitv.co.za. You can also contact the Eswatini Communications Commission on 2406-7000 or write a letter to ECCOM on PO Box 7811 Mbabane. Email address is info@ecom.org.sz.
All right, the numbers are in and they speak volumes. The latest edition of the Africa Pulse report from the World Bank paints a picture that is both sobering as well as strategic. A continent that is navigating complex headwinds, yet still holding pockets of promise. Now, to help us unpack the data, interpret the trends, as well as challenge the assumptions, we are joined by the World Bank's lead economist for the Office of the Chief Economist for Africa, Mr. Cesar Calderon. Let's dive straight into what the numbers tell us and what they don't. Mr. Cesar, I understand you're in Washington. Good morning on your end. Thank you for joining us on the program this Monday afternoon. We're in Africa, so it is good afternoon from your end to us. Let's start maybe with the growth with context. I want us to begin with the top line figure because this is where confidence either builds or it breaks. So according to the Africa Pulse report, what is the projected GDP growth rate for sub-Saharan Africa in 2025? And when we hold that number up against recent years, is this a rebound, a plateau, or a cause for concern?
Good morning. Well, good afternoon, Sifiso. Thanks again for the invitation. Let me put it this way. Growth in sub-Saharan Africa hit a bottom in 2023 with a rate of around 2.1%. From that moment on, it has been gradually recovering, not at a pace that would make a dent on poverty and not at a pace that would meet African people's aspirations. The projection that we have for 2025 is an acceleration of GDP growth from 3.3% in 2024 to 3.5% in 2025. And there is a forecast. The forecast from the bank also signal a further acceleration in 2026 and 2027 of an average of 4.3%. No? The region is very heterogeneous. So on the overall is being dragged by the performance of the large players in the region like Nigeria and South Africa that are still growing at rates that is below the ones that they had on average during the first 2 decades of this century. But again, as the region is heterogeneous, it shows also pockets of growth. One thing that comes to our eyes quickly when we look at the statistics is that 11 out of the 20 top growth performers in the world are in sub-Saharan Africa. No, and these economies, to have an idea how much are these economies growing, they're growing above 6%, are expected to grow above 6% this year, 2025.
Interesting indeed. You know, growth is always good, but I want to understand the forces behind this focus, right? It doesn't just appear, growth that is shaped by policy choices, commodity cycles, conflict, climate, and many more other things. What are the key forces currently driving this year's economic outlook, whether they are fueling progress or slowing things down?
Well, let's start with the positive news. Growth appears to be on a path to recovery. It's being anchored by low inflation. I mean, as you can see in the report, inflation has been declining in most African countries. More than 70% of the economies in the region are showing a deceleration in inflation. That is boosting the purchasing capacity of African consumers. So there is an increase in private consumption. And the lower inflation is also leading to either a pause in a hiking cycle of monetary policy, or is leading in some countries to lower interest rates. No? And those the expectations of African countries controlling inflation and lowering interest rates is going to propel investment in the future.
Yeah.
Now, the problem is that that's the good news. The not so good news is that the outlook is mired by heightened risks coming from global policy uncertainty and shifts in trade policy. For the region as a whole, the direct impact of this wave of trade restrictiveness might not as big, given that the amount of trade of the region with the United States is not as large. The region, 5% of the exports of the region go to the United States. I mean, that doesn't mean that there are going to be countries that are going to be more affected than others, especially those that are, if the reciprocal tariffs come back, those that have the highest reciprocal tariffs are going to be the most affected. And there's going to be also industries that are going to be affected. When you think about industries like automobile industry or the textile industry, right? Having said that, for the region as a whole, we believe that the indirect impacts of these trade restrictions are going to be bigger than the direct impacts. And what do I mean by indirect impacts? What I mean is the effect that is going to have in global growth that might reduce the demand for African exports. This impact is going to be bigger on commodity prices because, as you may see, commodity prices have been coming down as a result of not so great growth prospects for the world, and the reduction in global growth may also lead to lower investments. No, at the same time, on the other hand, you have financial spillovers that might arise because of interest rates staying higher for longer in the United States that might strengthen the dollar and might put pressure on African currencies.
It's interesting. You know, I have the report here opened on my device here, and I love how it is, bookmarked, improving governance and delivering for people in Africa. But it raises the question around fiscal strategy in a volatile world. A world that has a lot of tighter margins as well as shrinking fiscal space, something that you've already highlighted. But the big question then becomes, how do governments respond? What does the report suggest about how fiscal policies can be re-engineered to not only manage risk, but actually position countries for stronger resilience?
Yeah, I mean that's a key question, to be honest. Policymakers might, both on the monetary side and on the fiscal side, may have to they may have to do this balancing act of trying to address risks, but at the same time trying to think about putting the foundations for sustained growth in the future. On the fiscal side, if you look at the report, governments have been consolidating fiscally. The primary deficit, which is basically trying to net revenues with non-interest expenditures, is basically is getting closer to that equilibrium, to that balance. No,
Yeah.
We expect a primary deficit of 0.3% of GDP in 2025, and maybe a surplus in 2027, right? However, the drag is interest payments. Interest payments are still very high in the region. For the region as a whole, we're thinking about 3.4% of GDP in interest payments for 2025 to 2027. And that means that policymakers are making very painful decisions. So where do I allocate the money? Do I allocate it to pay interest, or do I allocate it to pay in development? And if you think about it, 20 out of the 48 countries in sub-Saharan Africa have interest payments that have been larger to the spending that they do on health and education combined. So what do they need to do? On the taxation side, they have to improve domestic revenue mobilization. They may have to, one way to do that is improve tax administration, tax collection, and tax compliance. What does that mean? You can use technology to try to reduce evasion and compliance by doing e-filing, platforms for electronic payments, registries of taxpayers so you can identify them. Then what I meant by tax collection is those taxes that you're supposed to collect, do them efficiently. Think about personal income taxes, think about property taxes, right? The property tax collection in many countries in the region is negligible. And on the expenditure side, you have to improve spending efficiency. You have to think about budget planning. You have to put emphasis on transparency, giving information to the population so they can engage what the government is doing. When it comes to debt, transparency is also at the heart of debt management. No? The government should try to provide information, to report information on loans, on terms and conditions of those loans, and try to announce, disclose to the public borrowing plans and what are the contingent liabilities, so the population can have an idea of the state of the public sector.
You know what?
I'll stop here for now.
Yeah, I did highlight, that its book ended on improving governance and delivering for people in Africa. And if we're going to speak about delivering for people in Africa, when I skimmed through the report, because it's quite a comprehensive report, I did receive it about a week ago, but it's a lot of information in there. One of the key words that I searched for was inflation, rightfully so. And the first inflation word that pops up is under the executive summary, and it reads as inflation cools down and converges to targets, and of course global and domestic financial conditions remain accommodative. It is expected that household consumption and investment will support the region's growth acceleration. Now, let's talk about what rattles households and boardrooms alike. That is inflation and currency volatility. How critical are these two variables in the economic story the Africa Pulse report is telling? What levels are realistically available to policymakers to rein them in?
No, I mean, I think you hit the nail on this, right? I mean, if you look at the surge in inflation that African economies went through in 2022 and parts of 2023, and then the disinflation process, it's driven by two things. One is the decline in food prices, no, and that to some extent was achieved thanks to several things, no, from external factors like easing of supply chains, reduction in commodity prices. If you look at international prices of food, they have been protractedly coming down since the peaks in the end of 2022, in the beginnings of 2023, and also the decline in energy prices, because energy prices affect transportation of goods, right? That's one thing. On the other hand, you have currencies. No, I mean, you have a lot of movement in currencies in 2024, but they have been in 2025 so far. Currencies have remained stable. In some cases, it has strengthened, and that may have to do a little bit with the slight improvement in growth prospects.
Yeah.
No, but it's critical. It's critical for the central bank to try to keep inflation's expectations well anchored.
Yeah. Eswatini, part of Africa, yes, a very small economy, a developing one at that. As we spotlight it right now, I do want to ask, let's take this lens. Given the broader regional trends, what are the most pressing fiscal challenges that the country faces in sustaining, first and foremost, economic momentum into 2025?
I mean, if I look at the macro poverty outlooks that the World Bank produces, Eswatini has grown around 5%. It's expected to grow around 5% in 2025. Part of that has to do with public and private investments in a series of large projects, especially water projects, right? But again, as you said, Eswatini is a small economy, but growth has been, to some extent, broad based. It has been pushed by services. You have growth in finance, information and communications and technology, and transportation, as well as wholesale and retail trade. Mining and quarrying is expected to continue expanding. So there are some positive growth prospects for the economy. On the fiscal side, the fiscal deficit is around 3.5% for 2025 is expected. It might expand a little bit more in 2026 to 4.5%. Part of the increase in the fiscal deficit in 2025 might be attributed to a problem of a fall in SACU transfers. To what extent SACU transfers are going to be affected by the tariffs, who knows? And on the other hand, you have also an expansion because of public investments. So hopefully those public investments are going to generate revenues in the future, so you can pay off that investment and also try to exert better control over current spending, particularly the wage bill.
All right. Mr. Cesar Calderon, the lead economist for the Office of the Chief Economist for Africa at the World Bank. Thank you so much for your time. Hope that you enjoy the rest of your day there in Washington. And thank you so much for your insights. This has been Market View, our Enterprise Watch segment. We'll go for a net break and we'll be back shortly. In the interest of time, Sanele, good afternoon to you. Welcome to the program. Let's start with the U.S. markets. This is our market analysis. The Dow and S&P 500 slightly down today. Nasdaq is flat. Are we seeing a pause in investor confidence? What is at play?
Thank you, Nomelo. So what we're seeing there is the issues to do with those China-U.S. talks. Remember on Friday, the world knew that China and the U.S. were going to go into the talks around the tariffs, and we've seen those come out to fruition today, with China lowering their tariffs against the U.S. to 10% from the 125%, and with America lowering their tariffs to 30% from the 135% against Chinese commodities. So we're already seeing the futures market responding to this. But when it closed on Friday, so markets closed on Friday, there's a reaction that markets were a bit on edge about how these talks were going to go. But fortunately, something has come out of it. And even though it's for 90 days, we do know at least that there is that still on the ground, on the table for those 90 days. So we should look forward to a very beautiful day on Wall Street today. However, we should not miss the moment that issues like your e-commerce have not been said. So if you cross over the pond to Europe, again, you'll see that the market's actually in a jovial mode because that China-US deal somehow signals that more deals are yet to come, that America is willing to make a deal, and we should expect other deals to come into the table pretty soon. So we are actually quite confident that we are going to see the UK deal come onto the table, the EU deal come onto the table, and we should expect to see the other Asian countries coming into play and really just making a deal as well. So when we cross again to Asia, again, it's a story of the markets preempting those news because if you realize that this news came after market close in Asia, but the markets were in a way preempting those votes, and they were actually banking on America and China making a deal which was actually somehow going to make it easier and a bit more predictable for commerce to go on. And, this is a very huge deal, de-escalation in those trade war tensions. So we're seeing the market in Asia as well, also closing on the screen. And if we come down to South Africa, Mr. Ngumalo, you will see again that South Africa is responding to those news positively, climbing up some 600 points to that 92,000 mark, because at least what we're seeing right now is a bit of gold bolstering the economy, a bit of export-led economy because of the relatively weaker rand, and, a bit of that minerals economy that's being running at the present moment. And the GNU currently stands in its present moment, so that's another positive for the South African market. And then coming into the domestic markets, we've seen a bit of marginal movement today with domestic stocks losing around 5.9% in today's trade, and overall that's 1.21% in today's trade to sell at 482.59 overall trade volume within the Eswatini Stock Exchange. Again, we're seeing those capital venture companies and those capital-led companies, just losing a bit on the background of everything that's happening within the global context. And then coming into commodities, oil has lost a bit ever since that announcement. That announcement of a China-US trade deal somehow brings back a bit of normalcy into the market, and we're going to move away from this hedging market into more of a trading space, into more of an equities market. The more we can get, the more clarity we get coming out of Washington and Beijing in terms of what's happening in terms of those tariffs. And then we're seeing the price of Brent crude as well, playing between 60 and 65 these days, being bolstered by that surge in demand that markets are now anticipating with the advent of this new trade deal. And but we're seeing some downward pressures on the price of oil coming through from the standpoint that, there is going to be that increase in overall fuel output being promised by your OPEC countries. In terms of the exchange rate, Mr. Ngumalo, we remain relatively strong against the euro and the Japanese yen, but we lost a bit of ground in today's trade against the European, against the US dollar, because of that landmark announcement that there's going to be some shift within the trade war, and that somehow signals that the dollar will soon be regaining its strength, Mr. Ngumalo.
Sanele, we are seeing indeed a lot of divergent trends across global markets, and you have made sense of it all. Thank you for your time. Thank you to our viewers as well for staying with us on the program. This has been Market View, the first edition of the week. We hope you'll be with us again tomorrow. Enjoy the rest of your day. Bye-bye.